Hey everyone, welcome back to Corporate Decoder, the place where we try to figure out if these companies are actually doing as well as they say they are. And this time we're diving into Chainbridge's latest financial filing. And folks, let me tell you, there have been some interesting accounting adjustments and a lot of moving parts behind the scenes. This report covers the period ending the 30th of September 2024, and it is an amended filing, meaning they had to go back and fix some things in their original report. Not exactly a confidence booster, but let's see what we can learn from it before we dive in. If you appreciate getting straight insights from these dense corporate documents, make sure you are subscribed, and if you want to chat more about these filings, join our Discord community linked in the description below. Okay, so the big story here revolves around some accounting corrections. The company is filing an amended report because they found some errors in how they handled a payment of $200,000 that was made back in July. The payment was supposed to be an increase to their bridge financing note, but they totally missed it. This means they understated their liabilities and expenses for the third quarter and the first 9 months of the year. They should have recognized that payment as an increase to the note and also an increase in expenses. But they didn't. Following accounting rules, these things need to be tracked meticulously. The company is also admitting they had not fully accounted for a $97,500 retainer, which made their prepaid expenses look too high and their actual expenses too low. Now let's look at the actual numbers in the balance sheet as of the 30th of September 2024. We can see they had about $429,000 in cash. That might seem like a lot, but compared to their total assets of nearly $12 million, it makes up a pretty small part. What is interesting is the amount in their trust account, which is over $11.5 million. That is money set aside ideally for future business deals or if things go south to give back to shareholders. This is significantly down from over $45 million at the end of 2023. On the liability side, total current liabilities are over $1 million, which is a big jump from about $68,000 in the prior year. This increase is largely due to amounts owed for accounts payable and accrued expenses. They also have a bridge financing note of over $1 million, which wasn't there last year. Looking at how they performed operationally, things are a mixed bag. For the 3 months ending the 30th of September 2024, they reported a net income of about $326,000. This is a swing from a net loss of nearly $472,000 in the same period last year. The gains were mostly driven by changes in the fair value of derivative liabilities and income from their trust account investments. For the 9 months ending the 30th of September 2024, they reported a net loss of about $1.4 million. This contrasts sharply with a net income of over $4 million in the same 9-month period of 2023. The significant difference here is how much the value of their investments in the trust account fluctuated. The shareholders' deficit section tells a story of a company actively trying to restructure. At the end of 2023, their total shareholders' deficit was a little over $79,000. By the 30th of September 2024, this deficit had ballooned to over $2 million. This increase is primarily due to the net losses incurred over the period and a significant increase in the redemption value of their Class A ordinary shares, a concept we'll touch on again. It highlights that while they have assets, the liabilities and shareholder equity situation is deteriorating. When we look at cash flow for the 9 months ending the 30th of September 2024, the picture is quite dynamic. They used about $626,000 in operating activities. However, they had a massive inflow of over $34 million from investing activities, which was primarily due to cash withdrawn from the trust account for redemptions. On the financing side, they used over $33 million, mostly for the redemption of Class A ordinary shares. Essentially, a lot of cash moved in and out, but the net change in cash for the period was an increase of over $424,000. This was mostly driven by financing activities that brought cash in, like the new bridge financing note. Now, for a bit of background, Chainbridge is a special purpose acquisition company, or SPAC. These companies are essentially shells formed to raise money through an initial public offering with the sole purpose of acquiring or merging with another company within a set time frame. They are not meant to operate on their own, but to find a target business. The company raised $230 million in its IPO in November 2021 and had planned to complete a business combination by November 2025 unless they liquidate. This search for a business combination has gone through several extensions and failed attempts. This note is critical because it details the very errors that prompted this amended filing. The company had to correct an understatement of its bridge financing note by $200,000 and an overstatement of prepaid expenses by $97,500. These errors meant their net income for the period was overstated and their expenses were understated. The impact of these misstatements was material, meaning it was significant enough to require this amended filing and a correction of their financial statements. It underscores the importance of robust internal controls over financial reporting. The initial public offering in November 2021 raised $230 million. Each unit consisted of a Class A ordinary share and half a warrant. The warrants are exercisable at $11.50 per share. Related party transactions are always a key area to scrutinize. Chainbridge, I had several transactions with entities linked to its sponsors like Chainbridge Group and CB Co-Investment. These included loans, convertible notes, and administrative service agreements. For instance, the company paid up to $30,000 per month for office space and administrative services to Fulton Assay, which is a related party. These arrangements can provide necessary funding, but also raise questions about whether transactions are truly at arm's length. Under commitments and contingencies, we see several important points. The company had a business combination agreement with Phytonix Bio, a deal that eventually fell through. This agreement involved a complex series of mergers, cancellations, and exchanges of shares and warrants. The key takeaway is that these SPAC deals are often intricate and can fail to close due to unmet conditions or shareholder approvals. The termination of this agreement on the 7th of April 2025 is a significant event that would have drastically impacted the company's future had it been consummated. The original business combination agreement outlining the merger with Phytonix Bio was quite detailed, describing how shares and warrants would be exchanged and how the new company would be structured. The ultimate termination of this agreement in April 2025 signifies a major shift in the company's strategy, or perhaps its inability to meet the deal's conditions. What happened after the 30th of September 2024 is also crucial. In November 2024, the company's securities were delisted from NASDAQ. This is a harsh reality for many SPACs that fail to complete a business combination within their mandated timeframe. Trading was suspended and their shares moved to over-the-counter markets. This delisting is a significant setback and can severely impact liquidity and the ability to attract further investment. The company stated they did not expect this to impact their business combination with Phytonix Bio, but we now know that deal was terminated. If that deal didn't go through and they have no other targets, it likely means liquidation. The management discussion section reinforces the going concern issue. They have less than $500,000 in cash and a working capital deficit of over $500,000. They have until November 2025 to complete a business combination, or they must wind up operations and liquidate. This raises substantial doubt about their ability to continue as a going concern. This section directly addresses the material weakness identified. The company acknowledges that their disclosure controls and procedures are not effective due to a lack of adequate review and reconciliation of liabilities. This is a serious issue for any public company as it relates to the accuracy and timeliness of financial reporting. They are undertaking remediation steps, but the effectiveness is not guaranteed. Now, for my take on Chainbridge, based on this filing Chainbridge, appears to be in a precarious position. The restatement of financial results points to weaknesses in their financial controls. The delisting from NASDAQ is a clear sign of struggle, and the ongoing working capital deficit and looming liquidation deadline, even after an extension, raise major concerns about their ability to continue as a going concern. While they had some income from trust account investments and changes in fair value of derivatives, this is largely passive income and does not reflect a sustainable operating business. The failure to complete a business combination within the given timeframe is a common pitfall for SPACs and often signals the end of the line for companies in this situation. Strategically speaking, the company's core strategy of finding and acquiring a business combination has not materialized successfully within their operational window. The risks are high, and frankly, the recent events like the delisting from NASDAQ and the termination of the Phytonix deal paint a challenging picture for their future. The only real opportunity is if they can somehow pivot or find a new path. But given the timeframe remaining and the current financial state, it is a very difficult prospect. In conclusion, Chainbridge is facing significant headwinds. The financial results from the period show a company with shrinking assets and growing liabilities. Combined with the operational challenges like the delisting and the failed business combination, the path forward looks extremely uncertain. It will be interesting to see if they can avoid liquidation and find a new direction. But based on this report, the odds seem stacked against them. Alright, that is our breakdown of Chainbridge's latest amended filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.